Welcome to part 2 of the Global EQD 2023 breakdown with myself, Jason Buck, and Jeff Malec. If you'd like to hear part 1, please head over to the Derivative podcast with Jeff Malec. In both parts, we break down what we thought were the most interesting pieces to the Global EQD event at the Wynn this year in Las Vegas. I hope you enjoy the show.
So this was tough because I wanted to say like that LT panel was my favorite one. But then our guy, Corey, was good on that panel. And then this panel is typically my favorite with some all-stars here. So this was leaders in volatility and talking about monetizing dislocations globally. So it was Natalie Reed of SIBO, which I still call CBOE. I'll get around to it eventually when you guys changed it. And that's Will Bartlett, CEO of Parallax, Robbie Knopp, head of S&P options trading at Optiver, Vishnu of Volar Capital Management, who used to be at Citadel, and Chase Mueller, I'm not sure, head of global macro at One River Asset Management. So a couple billions of dollars there on stage. And actually, the people who actually make the decisions for those billions of dollars, I'll leave that be. But yeah, give me your quick thoughts on this panel. This was the same crew last year, I believe, right? Might have
fairly close. You had it wasn't Robbie from Optiver. You had the CEO. I can't recall his name right now, and wasn't Vishnu. It was Ben Eifert. I can't remember if Chase was on the panel or not.
Yeah, but, I think it might have been this, but Ben Eifert instead of Chase.
I have a few pages of actually anecdotes that we can kind of go through, and right away, actually, they started with a poll on this one. What is the biggest risk the audience felt was in volatility markets, or that could affect volatility? And it was Fed policy was the
and then Vishnu came right out and goes, "Okay, I'm going to stop hedging that since these polls are obviously typically wrong."
Yeah, exactly. So Chase jumped right in because I think second on that was like the debt ceiling and default. And he said markets are looking through the risks and they don't seem to be concerned about default as they're looking at even cross-asset volatility, as everybody's like, let's just get this over with and keep it moving. But Vishnu came back with, you have to look at cross-asset vol for some asymmetric hedges. And so, you're taking basis risk when you're looking cross-asset vol. But we work with some managers that do that, and everything is because sometimes maybe you can't find the cheapest asymmetry in equity vol, so you have to use a little bit of cross asset vol to find those. But there's risk there, but if you spread your bets, it might be a decent idea. What was interesting, Will came right out with saying that 2022 was an aberration in low vol for equities. I thought it was interesting to call it an aberration for 2022. And so he was saying is the equities turn. So it was almost like flip. I like how Will tends to flip things around. Yeah. Is all we heard about in 2022 is equity vol is suppressed and rates vol is taking off. And then so almost like we were saying earlier, so everybody's kind of jumping on rates vol or looking for that cross asset vol. And Will was kind of like, maybe it's mean reversion. Like he felt like equity vol had been suppressed in 22, maybe moving into second half of 23. Do we see, equity vol picking back up? Is it equity vol's turn to kind of
that was his line, which was funny, right? Like they're kindergartners getting a turn. I think it might be equity vol's turn.
Yeah. Robbie had some like interesting stuff talking about, obviously he has a very unique view working at Optiver at the market maker and options. And, why, Skew was, poor in 22 was like we talked about earlier, like reduced exposure by, real money institutions. Everything was like scheduled macro data, right? Everybody's just waiting for like CPI prints. So that was really kind of like just like 1 day vol. And then he brought up, which was one of the other main themes is that structured product flow, and how structured product flow can kind of reduce, especially Skew with people, rushing for any sort of hedges. And he said, vol was, supply of vol was on downticks was just fine. What they said is how you've had a bit of reversal coming into 23 here where, Skew got crushed in 22 and we saw the return of realized vol or just long gamma positions where he's saying in 23, we're seeing realized vol come down and implied Skew start to go back up. But at the same time, he said still short Skew trades have been profitable this year. So it's a little bit of a mixed bag there. But that was interesting, kind of his perspectives.
and I think I asked you during the panel of like they use Skew probably in the correct professional way, and my brain is not the correct professional way, but right, they were using Skew kind of interchangeably with puts, in my opinion, right?
Yes.
So when they were saying like Skew worked, selling Skew this year worked, they're basically saying like buying puts last year did not work, selling them this year has worked. Was there anything more to that, or like
specifically you say like out of the money puts, right? Like that's where you're going to see the skew the most is more in your out of the money, deep out of the money puts. As we know, those people that were just buying deep out of the money puts as protection got crushed in 22. But then we're seeing a little bit of skew come back. So it's a bit of a trade-off, right? Like if you're buying those deep out of the money puts, you're getting crushed on skew coming in. But then as skew picks up, you're making a little bit of money on those, but it might just get crushed back again. You know, you don't know if this is actually when you're going to get your payout, or you're just getting kind of lulled into like a teeter-totter or a whipsaw when you're buying that kind of out of the money skew.
And then these guys got into the zero DTE a little bit as well, but mainly saying they're kind of on the fence. They didn't have a strong opinion one way or the other.
Yeah, I have notes on that. Before I get there, let me just finish on some skew ideas. Is like Vishnu pointed out also that paradox that, you know, skew is higher in bull markets. So as we're rushing up of bull markets, you tend to get a little more feel where people will buy a little bit more protection, right? Where he's saying, like we were talking about that telegraph 2022, you know, drawdown or recession or whatever you want to call it, is like you actually have skew coming in, and it seems counterintuitive. But he's seeing institutions, you know, implement a lot more call spreads these days. He said you can make money long skew and a grind up. It's just a little bit more difficult. Was interesting. Chase brought up that he feels that VIX looks relatively cheap compared to rates fall. So that one's quite the basis trade that you'd be looking at. And I've seen a lot of people starting to, you know, buy calls on VIX, but you know, as we saw, you know, implied didn't do as well in 22 that people expected it to do. So who knows? Like maybe Will said maybe it's VIX turn as well. I don't know.
Yeah. Did that seem weird to you that he's the pro quoting VIX? Right? It seemed like a retail-y thing kind of to say.
Yeah, and you still have some pros in there. I mean, you've had like Ruffer that will like you know, they'll take their shots on VIX calls. You know, in the past that's where they've been 50 cents. So, you know, it just depends on how large you are. And I think Ruffer is almost 30 billion ish. So that gives you an idea. But it's also, that's not fair to say 30 billion ish because, you know, they have some, you know, tail risk and long ball positions, and they usually use upwards of 3 different trades. And so VIX calls might be a small position in that, you know, relative to the overall size. The other another one of the ones that before we get to zero DTE is that Will said that commodity vol looks attractive because the Fed can't suppress it.
Yeah, I had that as well.
And so I think people have been talking about commodity vol for a while, and I think even Will has been talking. He was talking about commodity vol last year, but I thought that was an interesting anecdote that he threw in there at the end because the Fed can't suppress it. So that was an interesting way to think about commodity vol. So getting to zero DTE that you brought up.
And real quick on commodity vol, that's like the mother of all basis risk, right? Like, okay.
Yeah.
Right. Like, I don't even know where to start with that. Like copper, one of those, like oil, I guess. But
yeah, I think in this sense, like, I don't think Will's worried about basis risk. So we started talking about like VIX calls and everything. We talk about basis risk, but I think Will and Parallax is just they run cross asset vol books, and they're not really hedging against S&P, so they're not worried about the basis risk. They're just trying to make money in commodity vol.
Right.
So on the zero DTE front, Robbie was talking about that the liquidity allows for cheaper transaction costs. And he finds that HFT firms are starting to enter the space of zero DTE, and they're selling spreads based on back tests, which is always always pause for concern. And it's that idea too of like, if you look at any sort of longer term systematic backtest, everybody's going to tell you like 85% plus of options expire worthless, so you should sell options. I mean, but they don't get into, well, what's the price you're paying, what's your tenor, etc. But if you take that to the extreme, well, if I can sell options on a daily basis, I'm just compounding more effectively, you know, or quicker over long term. So I think that's what we see a lot of.
And who would you say is doing the spreads? ETFs?
Robbie said that I think maybe the HFT firms that you were coming in were the ones. HFT, high frequency trading firms. But he sees very balanced risk, which was kind of a theme we kind of heard throughout the few days. He said, you know, that you see more trading balance risk, but then they're raising the risk limits. So he felt that it was, fairly benign and fairly contained in a balanced market.
And he said he had an interesting way to look at balance, right? He said it's balanced with volume, with liquidity, and I'm going to forget the third thing. Like what's his name? Don't ever hold your fingers up. But right, they don't just look at it like, okay, that's the order book's balanced. They're looking at it. He said they did a deep dive, did this research, went across volume, liquidity, and whatever the third one is, and saw no disruptions there. And then I think you might have misnoted that, because I had the note of him saying ever since the zero DTEs have come out, they haven't had to adjust their risk limits once. So basically saying, as a market maker, if you're scared about all this stuff, we haven't had to like have a special meeting or had like, oh my God, the risk is all out of control one time. Basically saying like, everyone calm the hell down. Like, this is just normal operation for us as a market maker. It's a new toy, it's a new tool, but the balance is there. And that was the key, right? Everyone's worried of like, oh, if this thing gets out of control, which is always weird to think about, right? Because everyone that's bought is sold and vice versa. So, but I think they mean the balance. If everyone bought them and just the market maker on the other side,
right,
and then the market pins at that thing, and the market maker has to cover. That's what could cause this liquidity cascade. TM Corey Hofstein, but he's saying no, it's balanced. We're seeing client flow on both sides of the order book, buyers and sellers, so they're not nervous about it at all.
Yeah, it's good. It's a good way to point out that the balance risk is more like the gamma effects of the market makers trying to lay off their risk. And thank you. That was a function of my notes. So I couldn't read my own notes. So it had said trading more, and then I see raised risk limits. But then after you said that, I realized I wrote haven't, but I couldn't. I was like, is that honest? What is that? Like, so yeah, like you said, they are trading more, but they haven't raised their risk limits. So that was a key point. Yeah. And like, so the
as hard you know, I'm having a really hard time reading my notes, but yeah.
So like Robbie, being co-head of S&P options trading at Optiver as like a market, like he would have the most interesting things I would think to say and the most expertise in like zero DTE options. But then the second order effect of that is like, what is he saying on stage versus what they're saying privately? So that's the only caveat I'll give to it. But like, if I want to hear from anybody about zero DTE, I want to hear from like Optiver.
Right. Not the person like creating a gamma model based off publicly available data and whatnot. Like, here's what's happening. There's a huge gamma squeeze going to happen. Like, no, this guy's living it every day. Probably many multitudes of capital personally at risk, right? As well as the firms at risk. So yeah, I agree with you 100% of like, I would trust his opinion above all else. But then the other guy, I think they all basically said like, yeah, we trade it. But no one was like, it's the best thing ever. We're making tons of money. We're doing zero DTE. It was just kind of like, yeah, it's a new tool in the toolbox. Right? Do you get a different feeling?
Yeah, for the most part. And I'm just trying to think. I'm looking at some of the other notes from like Will and Chase, and I love, Will's not afraid to step in and push back or be contrarian. But he was saying like, he's like, basically everything's gotten shorter term. All life and trading gets shorter and shorter term, whether we, used to watch 2-hour movies to watching 20-second TikToks. Like, so he was just kind of saying everything's shorter term. He's saying they use it as a tactical complement to other things they're doing. Like you're saying, they're like barely using them. He said the implied volatility looks cheap to the realized volatility on event spreads. But he was also saying, well, this is what I thought was interesting. He said he felt the transaction costs were high relative to the vol exposure that you get. So where Robbie thought that the liquidity allowed for cheaper transaction costs, I think Optiver is going to have a very different perspective than Will's going to have, kind of from market maker to buy side kind of. And so it was interesting that he felt the transaction costs were too high. That's where they weren't using them, but more as a complement. And he actually said it actually surprised him how successful it was. So he had an honest admonition there that like he didn't think that zero DTE was going to get the volume that it has or grown over the last year. And so he said he's been generally surprised by that. Chase was saying that like and I shouldn't write this down because it's like confirmation bias for me, but he says it's not cannibalizing the 1 to 3 month trades. So you didn't see, volume has been coming down in like the 1 to 3 month trades, and volume has been rising in the zero DTE, but like he's saying they're not related. The volume in the zero DTE has nothing to do with the volume in the 1 to 3 months.
Everyone else is saying like it's just purely coincidental that it's in inverse lines, right? Which seems weird, but he would know.
Well, it also starts with though too. It's like, do you think who creates the volume, buyers or sellers, right? And so for me, these zero DTEs is just people wanting to sell zero DTEs, and so everybody's been saying it's like retail buyers, etc. But like, is that really true? I'm not so certain. Like, who creates the supply and demand? Sometimes it can be inverse. And shout out to Chris Citadel Ambrose. They wrote a paper about the zero DTE if you want to go look it up, and that's what their researcher found as well. Is it's more institutions or hedge funds selling, and not necessarily retail trying to punt on a basically a directional play on a daily basis.
And then I had the note, but I can't read my numbers there, of his example, right? Or maybe I just wrote an example to help me think about it, of that the vol's expensive, right? Was basically like, if you're paying, right? Chase was thinking of like, you pay only 2% spread or whatever the number is. Maybe it was 50 bips or something. Right. But Will's thinking, we're like, okay, I paid 50 bips, but I'm really only realizing 1%. I'm getting 2 to 1. Right. If I have a 3-month option, I pay 50 bips, basically the same spread, and I can get 15% realized, right? Then I'm like 30 to 1. So that's where his mind was of like, okay, but you're kind of expensive for the realize you're going to get in that day. Like, how far is one day going to go is the ultimate question.
Yeah, remind me of the arguments I used to have with you about like the tick size for VIX contracts.
Yeah,
even S&P. Did somebody else
bring
up tick sizes for S&P too? Like at one point, I think maybe it's in my notes for later.
Yeah.
Will also said that a black swan event can and will spike fall, but he's like nothing on the radar. Because I think somebody had a question about black swans, and like we're both like tautologically like, they're like, tell us what black swan's coming. It's like, you can't. That's why it's a black swan. So what Robbie said though is the black swan, especially for zero DTE, that was a lot of rumors going around the event, was the proposal for intraday margin. Could exacerbate vols with rolling margin calls. So that's the other reason why we've seen the rise in zero DTE. It's a function of regulations. It's like, you don't have to post that much margin for these intraday options trades, and that's why people have been really pulling them off in size, and why you see that volume increase. But if they were to move to intraday margin requirements or raising those, that's when you could just see, like you're saying, just a cascade of margin calls. That would be a systemic risk to the zero DTE space. But is that a cascading risk to the systemic, financial system? Is a whole different, ball of wax or topic of discussion.
And then that didn't even make much sense to me, because if you're out each day, there shouldn't be margin calls, right? You just put on the margin every day, so you just wouldn't put it on the next day.
Yeah, it's just, but if you're intraday, if we had a movement and they got margin called and the buffer, at least on the market makers, right, you could have a cascade of like bankruptcies, basically.
I was taking it to mean there's this like 30 billion in zero DTE volume that has a margin associated with it, which is true intraday, but not true day over day.
Right. Correct.
And then if the regulations come in and take that away, that margin goes away. We're saying, as it would be applied intraday,
yes,
it would exacerbate and cause, which would be, we wouldn't put it beyond our government, but right, which would be dumb. Like, hey, we're going to try and make this safer, and we're going to add basically circuit breakers that make it worse.
Yeah, and so you're right. There's countervailing forces, right? Going in the next day, you just don't put it on the trades, but everybody gets wiped out in that day. So that's the kind of the issue there. And then Chase just pointed out this mainly been massive isolated vol events throughout the last like year and a half. It's like more like one day kind of events. So we've seen those spikes and vols, but then it just mean reverting just as quickly.
Yeah, and I wrote down contagion. Were they going into contagion? Like, until we see, right, those isolated events haven't bled into, right? They were in bond vol, they didn't bleed into equity vol. They were in like the ruble in the beginning of the year, it didn't bleed into equity. So and I think it was Vishnu bringing up like, am I on the wrong panel there? But Vishnu's here. Yeah, right. He was bringing up like, until you're not going to see a big blowout and vol really spike until there's multi-asset contagion.
Correct. And then
what makes that happen is the billion-dollar question.
So once again, though, too, we're always trying to decipher, on zero DTE, how much is like retail non-toxic flow versus like toxic professional flow. Is Robbie pointed out, this is what I love too, is like, he said so much of it trades electronically. It's hard to decipher these days between retail and institutional. And I thought that was a great point out because, like you said, everybody's selling, their products for how to decipher between retail and institutional and gamma positions of market makers, but then you don't know what's in dark pool. Like there's just so much unknowns there that I thought that was a great pointing out that with the electronic trades, and then not only, you and I've talked about this many times, is not only the electronic trades, but then electronic algo execution trades for like hiding with icebergs, etc. It's like it's hard to know if that 50 lot trade is or 5 lot trades retail, or if that's institution just tranching into the trade.
And then we talked after the event or somewhere in there of like, it's funny to think of, right? Retail flow is usually non-toxic in the market maker world, right? They don't want to get in front. They don't want to see an order, get in front of it, and then it's some institutional player that can come 10x the size over it and cause them a big loss. So it's in their benefit to know who's retail, who's institutional, so they don't get in front of the wrong person. You had an interesting point with these 0 DTE, that when does retail's non-toxic flow become toxic? This was all even in meme stocks, and they were tying in meme stock a little bit stuff as there. Well, like it builds this momentum, and then the non-toxic flow becomes toxic flow because they're moving all in the same direction at the same time.
As soon as they in aggregate and in correlated nature move in the same direction at the same time, that's like nuclear toxic or something. Like it's just a whole other level. It goes from non-toxic to just like get the hell out of the way and shut down.
Just
your
flip
book.
sign immediately. Like, and then I asked the question at the end.
Oh, I was going to tee you up. I was going to tee you up, but I was just saying for like Vishnu was saying, like going back to what you're saying about Vishnu, is he sees that cross asset correlation is where we could see a potential like black swan. Is like, once again, if we see yields down, stock down, potential world, like back in March, that can be an issue.
Real quick on that. Sorry, but isn't that interesting? You 2 panels are like, if we see yields down, where they say yields down, stocks down, yields up, stocks down.
No, I think Vishnu's saying like rates down, like yields down, stocks down.
Okay. I was coming from the same point, like we just had bonds down, stocks down. So if everyone's like, oh, that would be a big black swan thing, then like we just had it. How could it be unexpected?
If everybody's positioned for, that's what I'm saying. Everybody's positioned for the previous, like he's saying, going back to the previous like few years ago, like our last few decades, where everybody's positioned the opposite now. I think it was what Vishnu was trying to say because of that cross asset correlation flipping again. So then it was question time. So you got in a great question. So I'll tee you up for that one. That was you're showing your big brain memory from last year with Will.
Oh, you're going to tell him what my handle was in the question app? Yeah.
Oh, what's up with the moss? Wasn't that your question?
There were some butterflies/moths that were plaguing
Vegas.
2 or
Vegas
3 of them
full bloom. Yeah, in
the win place. But yeah, my question was like last year, and they kind of misconstrued it. So we'll get to clear it up here. That's why you have a podcast. So last year there was a lot of talk about dispersion doing great. This year, 0 talk of dispersion, and a lot of talk about how gamma had done great last year. That was the part they missed, right? And so my question was like, hey, last year we were talking about dispersion doing great. Nobody was talking about the gamma trade, which is like at the money, don't rely on a Vega pop, rely on it approaching your strikes. So question was simply like, last year we're talking dispersion, no one talking Vega. This year we're talking gamma. This year we're talking gamma. No one's talking dispersion. What's next year going to be? What are we going to be talking about next year that we didn't talk about this year? So they misconstrued the question and thought I said gamma is working this year, and they're saying no, it's not working so far this year. The past few months hasn't seen gamma working at all. But Will jumped back in and jumped on his sword and said, like, yeah, I called last year that dispersion was going to blow up. Way too much money in it, way too much excitement about it, and that correlations are going to unwind, and it's going to be a pain trade across a lot of firms. Like, didn't happen. I'm going to double down. He's like, it's still a big risk. I still see it having problems. He said they're still involved in it. They still trade it, but he sees a big risk in that dispersion trade as well. How'd I do? Yeah.
Perfect. That's end of day 1.
End of day 1. On, what are you thinking? We'll do 2. You'll put the day 2 on yours or something like that, or just do these both on both sides?
Yeah, we can split it up. We can do either or. I have another like 25, 30 minutes if you do. And so we'll probably, I think this day is going to go a lot faster if you want.
Yeah. All right, let's go. So day 2 started off with Tom Lee of, let me pull up my chart here. Sorry. Tom Lee of Parametric. How come I don't have that? Keynote, Forecast or Forge, Building Resiliency in a Risky World. So it's Tom Lee, CIO of Parametric. Talented public speaker. I like his style. Kept us all engaged. And we could go way deep on this, but we're going to keep it high level. But, everything you're always talking about, right? Complexity, emergent behaviors, had some interesting stuff on probability versus confidence, right? And an option needs to know not just the probability, but also the confidence, and how the confidence brings in the second order, right? The first order of uncertainty is just the probability. The certainty brings in the second order of probability, which is the range of probabilities. Like, okay, here's the probability, but what's the probability that this thing actually happens way over here? So the range of probabilities. And he was kind of bringing that back to build a resilient portfolio. You need to think about the range of possibilities, which you would call paths, right? And think about those range probabilities, the path dependency, and build a resilient portfolio that can exist and not get blown out in each of those range of possibilities. So how do you build a resilient portfolio? Diverse, liquid, attentive to cost, cautious of complexity, which was sort of interesting. But then he went with like a core satellite approach. I'm like, well, that's like everyone knows that thing. So he lost me a little bit there of like, you had all this great stuff, and then he went with a simplistic example. And then the other interesting thing, and then I'll let you go on here, is he had this pyramid of basically investment products. At the top was pure alpha, right? That gets charged 2 and 20. Next was hedge funds that are basically still 1 to 2, a little bit less management fee, but still 1 to 2 to 20. Then alternative beta, which gets down into your 50 bips to 100 bips. Then indexable alts, which get down to like 10 bips. And then market beta, which we know like SPY, which is down less than 5 bips. So it's kind of this interesting that products and strategies kind of move down this pyramid. So 20 years ago, we might have thought a simplistic carry strategy was alpha, and kind of now you can get that as a alternative beta. So it's moved down that thing. And then even 50 years ago, we would have thought owning all 500 stocks in the S&P was maybe some alpha, maybe indexable alts. So that's moved way down the chain. Yeah, and he basically was saying to protect against moving down that chain, managers add complexity, and they add all this stuff, and you have to be careful of, is that complexity just to protect their turf and not move down the pyramid, or is it actually to provide resiliency?
Man, unfortunately, I was in a coffee meeting this morning. I would have enjoyed that talk, it sounds like. But what has been interesting to me is it was also a side theme throughout this, where it's always these conversations about alpha and beta, and these conversations like fascinate me. And part of the rub I think I always see between people, and I think Corey talks about this often as well, is like the idea is alpha is unexplained beta, but most traders or managers have to have an explanation for their alpha. So like they kind of preclude each other in a way. It's like, or most people don't want to like take the Rentax style alpha if it's unexplainable, because they want to have an explainable strategy and thesis to their investors. Yet we're saying alpha is just beta that hasn't been explained yet. So it's just an interesting like,
right, it's like what's the you'll know the term, but like once you notice it, it's gone basically. So once you explain your alpha, it becomes beta. And then he had an interesting, with managed futures, he had an interesting thing of like an example of adding complexities, like to protect their turf. A lot of trend followers, managed futures added complexity. Maybe they added some long only, they added equity tilt, they added different things that resulted in a lot of tracking error, right? Versus the fictitious managed futures beta. And he brought up, which you've talked about ad nauseum, of like, okay, this dispersion between every year, the top, the CTA index, the top guy to the bottom guy is like, he quoted, I think, 7% dispersion. We've seen even larger than that. My pushback on that would be, hey, if you know what's going on underneath the hood, this one's an energy trader, this one's a short-term quant trader, this one's a long-term trend follower, that it's not as easy to just say they added complexity, that's why there's dispersion. To me, it's like they're doing massively different strategy types, and they're just poorly categorized and lumped into the same category. But you even see that in the SocGen Trend Index, similar dispersion. So it is there. But that I just kind of argue back with that of like, is that adding complexity for the sake of protecting their turf, or are they adding complexity to be the best they can be? Who knows? Yeah.
Even if they're doing the same as you've seen over those decades too, even if they're doing relatively similar things, the dispersion can still be wide, right? Like just different lookbacks, different trading time horizons, breakouts versus crossovers, how do you define a breakout? Like all those things matter over the longer term.
And then one of the questions by someone, I think, whose handle was Mothman in the question app was, how do you think about whether added complexity is worth it or not? So he didn't quite have the time or thing to get into that, but he was kind of saying, comes back to understanding what it's doing, understanding, is it complex for complexity's sake, or is it complex to the average person, or is it complex to you? Which was interesting, right? He's like, okay, one man's complex is like, oh, options scary, which we actually heard on some of these other panels. But right, if option scary is complex, well, hey, I understand these options inside out. This isn't complex to me. Therefore, I don't think adding options overlay or something to a portfolio is adding complexity for the sake of complexity.
Yeah, if I go pop the hood on my car, it's going to be like incredibly complex to me. Even if it was an old car that somebody could figure out pretty easily how to work that mechanical system, I'm going to be a complete moron, and that's going to be overly complex to me.
That is a great example, and apropos to me, because I would be in the same boat of like, what? This looks like the engine block.
And to me, like a microwave is nothing but magic to me. So, I mean, again,
it works. What a great invention. What do you think is more important for society, the microwave or the refrigeration?
Oh, I was definitely refrigeration. I thought you might go AC, because that's like what changed, any sort of equatorial country or the South.
But same technology, right? So the ability to cool the air instead of the food. Next panel was, you done with that? You got any other thoughts on forecast or forge?
No.
But yeah, I thought you'd like that, because that a different way of thinking what you call path dependency, and covering all paths is resilience, right? Creating a resilient portfolio.
Yeah, unfortunately, I was at a coffee meeting, and I was making plans to meet up with Jem in Istanbul. So unfortunately, I missed that one.
Next panel, options block liquidity, how institutions will benefit from the technology of tomorrow. This was super in the weeds, super inside baseball, right? You had head of Citadel Securities, was it?
Yeah, so it's like, is this a panel when the moderators, Jason Rolfe at Citadel Securities, and then one of the panelists is Dave Silber at Citadel Securities, and then you have Rob Wolkis from Waratah Advisors. So yeah, it was very in the weeds about trading options block and liquidity and everything. So I just had some anecdotes, and then you can add to it. But it was interesting, actually. Jason, the moderator, actually was even jumping in more than any other moderator, because I was a smaller panel. But he was saying he thinks that institutions follow retail traders in options. And I was like, that was a hot take that he didn't necessarily expand on. But he also thought that, like I said, these are more anecdotal, but like that dispersion is down to like 2 weeks. So they're seeing the dispersion really take effect over a shorter time horizon I guess depending on who you are in your time horizon, might be shorter or longer. But he really pointed out that 2 week mark.
But what do you mean there? Not the dispersion we were talking about with a dispersion trade of the. What do you mean on the 2 weeks?
I thought he was talking about like dispersion trade on that more like the 2 weeks is where you're seeing the most dispersion between index and single name.
Oh, he could. Yeah.
One of the other things, like almost like he pointed out too, is that he feels like there's extra liquidity in single name options compared to their underlying asset. So that would be almost a Jem Carson, like tail wagging the dog. So you had like those counterintuitive things where like institutions are following retail, and that the options are more liquid than the underlying reference asset that they're overlaying. So that was and then this was just pure anecdote, but he's like, daily volume at the OCC is quote unquote astronomical.
Astronomical.
So, yeah, that's more.
So I had jotted down that the options execution is basically just catching up with the rest of the market. of what we've had for years and years in single name securities and even in futures. So block orders on the screen, algo execution. And the Citadel guy was kind of saying like institutions sometimes still have to call. They have to wait for an auction to get made. They have to wait to see what both sides that are, and the advances are going to be. That all happens immediately. I think he was even saying like a Bloomberg plugin that could be possible where you're seeing your auction inside of Bloomberg. There was a little Bloomberg hating there of like, hey, we all, right? Like we know we all use it. We know we all hate having to pay the price. And then they dropped this little nugget unintentionally, I think, but that Citadel Securities has compounded volume at a growth rate of 80% a year since 2020. And that 70% of the volume is done electronically through them, 70% of it. So yeah, moving towards auction automation, and that was it. Less clicks, less friction, right? That was kind of interesting, like bringing it back to retail and Amazon, and they're just trying to get to less clicks. Oh yeah, and then I had the same thing. Retail's the tail wagging the dog. Institutions following retail in if retail causes the liquidity to increase. So I had that if, right? They're following it in if when retail comes in, the liquidity increases. So it's kind of coming back to that like non-toxic turning toxic, right? So if they're seeing it kind of concentrated movement, they're now switching sides and they'll follow it in. And then he also said the large increase in leaps volume, especially in rates.
Yeah, I mean, I think you'd see longer out rates in general than you would see in like any sort of equity.
Yeah, because your liabilities are going to be longer.
Yeah.
Moving on, we had equity and systematic strategies in the new regime. I think we'll both politely say this was one of the least interesting ones to us. Is that polite enough?
Yeah, I was trying to think of what we politely say this stuff, and then in not any individual, but I was also wondering if like how much the host actually does matter. You know, we think sometimes the host is like inconsequential, but maybe driving the direction and arc of a conversation and tying things together might be. And I'm not saying this was the case in this scenario, but it was just making me think about some of the panels that were kind of just more, you know, people just whipping back and forth anecdotes and no real follow through or conversation. But
yeah, and I think it was kind of set up too. Right? It was a bunch of, some of them were just doing long only, some were doing income strategies and equities. So it's kind of like big, simplistic, I don't want to use that in the wrong word, but quantitative models that are doing not advanced option whatnot, but how many securities to own and which securities to own. They did get into a little bit of like back testing.
Yeah, that was the only interesting part that I had some notes on.
Yeah, and one of them said back testing. They don't mind the shorter back test, and that a human is needed to judge the length and the approach to back testing.
Yeah, that was Linus at BlackRock was talking about how human sensibility has to see the parts that the back test doesn't make sense, right? Or that was outside the parameters of the back test. And then related to that is like, we've talked about this many times before, like systematic is about, and I think this was from Sharon, she was saying systematic is about creating a low cost automation of emotional fundamentals. So when everybody goes, are you, systematic or discretionary, it's like, well, every systematic rule had discretionary emotions embedded in it.
Right.
And so, you and I have talked about that many times, but
what automating what a good fundamental manager would do at scale and at cost.
Right. And then Beryl followed that up basically too. Is we're rules based at Neuberger Berman, but the inputs can be emotional. And I thought that was another interesting way of putting it, is like you can have emotional battles about the inputs, but then it's all rules based once you get those in there.
And then Beryl also had an interesting point that their models look at the current market signals and not historical. So I took that to mean they're not saying, hey, every time the market's down 6.5%, it rallies X%, and that's what our model's working off. It's just when X indicators above Y indicator, we're getting into those. I think it was more fundamental than that of like, if the price to earning is X, we're getting in. And then I won't name names here, but I had this, someone up there said they take some liberties in adjusting the models based on the macro environment. And I just wrote down WTF. So it's like, what? That's like, to me, quant 101 of like, no, you don't adjust the models
Yeah.
based on what's going on. Because how do you know, right? You just picked up the paper or you listen to a podcast and you're like, oh my God, this SVB stuff is terrible. Sell
I,
everything, take some liberties.
I, I wonder how much that is part of the zeitgeist, though, because I think about how many of our potential clients ask us that similar question, and so maybe that's what they're using as a narrative for their clients, is that they're attenuating their rules based to the macro overlay.
So
And
they're
because I get
smarter by half. They're just throwing that in
yeah,
there, even though they don't do it. Yeah.
I don't know. That's my my dubious questioning of that, but like that's because I just hear that more and more often these days. So it's just I don't know if that's kind of in the ether. And then Linus also said they use options as a smart money indicator. So I thought that was kind of interesting. But most of the stuff was very, whether it was BlackRock systematic or Vanguard, it wasn't as interesting.
Yeah. So moving on, we had the next one was
This one should be good.
a combination approach to building a diversifying strategy portfolio with Roberto Croce, Jim's brother. Just joking. Newton, Joe Elminger, Powis Forjo, Grant Jafarian, and Ryan Lobdell. So I had stepped out here, so I'm going to let you and flew home. Left you.
And why I said it was interesting too is because obviously Grant Jafarian, famous Chicago trading family that you know well. Ryan Lobdell works at Makita with my buddy Jason Josephiak, especially on their RMS strategies, their risk mitigation strategies. And then Powis works at UPS Group, but I think he's in a separate division from Roxton. But I always like when Powis is on there, it's always interesting. So I have a lot of anecdotes. But basically Grant was like talking about how trend following has evolved a lot over the last decade. Mostly how managers have moved much more towards long term, like 6 months plus, with the addition of carry and beta. So as you're saying, as managed futures evolves and people want to add carry and beta to provide better return streams, but the actual trend piece has moved much more longer term signals, like 6 months plus. Do you think you've seen the same thing in the last decade? I mean, especially during that lull of the 2010s.
Yeah, definitely. If you wanted to survive, was go longer term, add beta, yeah, and or carry. Much to a detriment in some cases. Like, okay, are you going to perform in a 22 when that happens? Which most of them did. So I think that's what's lost in that conversation. Like, oh, you're adding these dangerous pieces. You're adding this dispersion from the true trend following.
Right.
But there's nothing to say they can't turn those pieces off, or like when trend comes fully back, like they can be dynamic and switch around. But that
they can use the macro environment as an overlay
yes.
to it anyway.
They can take some liberties.
Joe had an interesting point about the Wimbledon trade. I don't know how much you know about that one. When
the insurance,
the tennis tournament, how they were basically paying $2 million a year for pandemic insurance. And a lot of people were like, "That's stupid. That's a negative line item." All that stuff. But it was based on their capex growth. So that was an interesting, like almost like we were saying with, whether knowing if flow is toxic or non-toxic is like, you don't know if somebody's hedging their book, if it's a directional play, what they have in dark pools. Well, now if you're talking about actual businesses and having to have capex growth, you don't know that like the hedging creates a lower cost of capital. So Wimbledon had decided to be a preeminent tournament moving forward. They had to put tens of millions of dollars and quite frankly, hundreds of millions of dollars over a decade into building out their facilities, restaffing, all of those sorts of things. So if
better strawberries,
like all of those things are like more champagne and strawberries. So no one likes bleed, but still like it saved their bacon, right? They were able to survive, and surviving is the only success. But it was interesting how much that hedge was not necessarily predicting a pandemic, was more like hedging their capex spending. So I think that's always an interesting way to think about things where, in options world, everybody can get what they want, because you don't realize that, real economic, hedgers, especially whether it's managed futures and options, might be hedging, their exposure to, commodity versus refined product versus, cost of capital. So you really don't know kind of what's at play there. And Grant was talking about too that like strategies that offer genuine diversification need dispersion. No, there is no benchmark, and it needs to be timing oriented. No passive, no benchmark, and you need dispersion for the genuine diversification that managed futures can provide.
So he must
I
have been
think
jotting down when Tom Lee was using that as a bad example of
yeah.
like, oh, I'll show you dispersion.
And then Roberto asked, I think like, why do you need active? Why not like QIS, which is basically QIS, like quantitative investment strategies are basically like systematic passive factor investing. So Joe's response with that is everyone has thousands of bespoke indices. The rules based doesn't adapt to a changing market. So going back to the idea of like a macro overlay, or like you're saying, even if managed futures had on, carry and other beta trades that they can switch, the more trend trades or just adjust kind of like a dimmer switch, how much exposure they have. What was interesting too, like we were talking about that dispersion with managed futures and trend players, is like Ryan pointed out that trend directionally correlates, but P&L dispersion can be large, and so it's best to use ensembles for clients. I'll just mic drop that one. Couldn't agree more. Oh, this is where the tick came in. So even Grant brought up that the tick size for E-minis, that $12.50, makes it difficult for the execution costs, right? You have to innovate on the execution cost side. And so he was pointing out that like the HFT and other front running traders make their execution costs so much higher for trend followers than they have been historically. So part of a CTA or trend following firm these days has to have a division that's really working on their execution costs and making sure that they can have better execution costs. So that's that bit of that Red Queen principle that we find where everybody's like, well, I can use a trend index, I can do trend at home, all that stuff. But as we know, the firms that are working hardest is actually on the reduction of the transaction cost side and worrying about, disguising their orders for the HFT firms.
And that's like a big fund problem, right? Like if you have $3 billion of your huge trend follower, but point taken. And then interesting, I think QIS used to be called risk premia, right? Have we gotten rid of the risk premia name and now it's QIS?
You saw that popping up too, and the factors, and it's just all like everything has just a new acronym and everything. Which I always joke with the guys at Makita about their RMS, their risk mitigation strategies, is like the new version of tail risk or long vol, or managed futures or commodity. Once again, managed futures, commodity trend followers, CTAs. Pick your poison. And then obviously Ryan's, with their RMS strategies, the person after my own heart. He said, you need to size the allocation to like managed futures or trend to the payoff you need. Like a 1% allocation doesn't do anything. And so, Makita's, advising trillions of dollars. And so when they're talking to large institutions about their allocation size to trend following, you can imagine when they're having those conversations, they're like 1 to 4%. They're like, what's the point? You're actually not doing anything. But that's usually a lot of the conversations they are having.
I'll throw out a shameless plug for our Guide to Trend Following white paper that has a whole couple pages in there on that, which was based on a great work by Welton a bit ago. Like by a bit, I mean maybe 15 years ago. But it was basically showing, okay, if you expect 6% annual return, whatever, and you want to get to 10, it was just simple math, right? Of like you're expecting 6 out of your 60-40 portfolio, you want to get to 10% a year to meet your pension liability. What does this allocation of these alts have to return? And it was showing like at 5% allocation, it has to do 78%. So it's just like, I feel like that's a better way to frame it of like, okay, you're into it, you like the diversification. What do you think this needs to return in order to do what you want it to do? And they'll be like, right where it's at of the 15%. Like, no. Then you need 25% exposure. So kudos to him for recognizing that. But I would love to ask him follow up of like, how many of your clients actually listen and do more than 5%? Which I bet.
So the next panel, so unfortunately we're getting hard up on time here. So the next panel was on fixed income factors, and my buddy Roni Israelov from Endeavor, formerly of AQR, was on that panel. And so maybe I'll shorthand this. Is like recently Roni's been making the podcast rounds, and I highly recommend his episodes on resolve riffs and then Corey Hofstein's flirting with models. And Roni really breaks down like corporate bonds and short dispersion trades. Like he views like why be in corporate bonds when you're basically long treasury plus risk premium and short a put. And so Roni can go into all those details, and I highly recommend listening to any of the podcasts he's been on recently, because the stuff they're doing at Endeavor is very interesting. And to your question earlier, is like they're building LDI ladders for retirees. And I think that's a really interesting differentiating factor for an RIA that nobody else is really doing. And he's just bringing all of that firepower that he's built with AQR over the years and applying it at Endeavor now. And it's really impressive what the kind of using the technology and what they're building out there.
And really quick, what do you mean by LDI ladder? So you're matching their, I have 200K spend in the next 5 years, then it's down to 125. So cool. We're going to get you this income at those milestones.
Right. Tagging you when you have those income needs, or for other people, be liability needs historically when you're an insurance company, but for individuals, it's when you need those income, and then tying your treasury ladder to the exact income you need. So that way you're always just hitting it dead on for all those tranching out the years of your future life. Especially at today's rates. That's what makes that even possible, right? Yeah. And then a little bit of, fireworks, or trying to, before I had to catch my flight, the last discussion, because it wasn't a panel, a discussion I caught was, does the rear mirror see the wall ahead? With Mike Green from Simplify and Jem Carson from Kai Volatility.
Great title.
And great title. I love a good Kierkegaardian reference, right? That we only understand life through the rear mirror, except for we have to drive looking forward. So that's always the tough part about life. So there's a little bit kind of anecdotes in here. The problem, I think, actually was, with both these gentlemen, they're quite verbose, and I think they gave them like 30 minutes to talk. Oh, and so I think they were trying to jam a lot into 30 minutes. So it's kind of a little bit of back and forth. And so basically the conversation is like, can markets price in a future event? And Jem's pointing out that we had the rise in 0DTE because Vega didn't work, and the RV Gamma has the realized vol and Gamma has worked, but now he's saying the realized vol is dramatically compressed. So he's just once again touch on the 0DTE. Mike was pointing out that the least sensitivity of VIX to S&P moves is nobody cares about 30-day vol, and so VIX is priced on expected 30-day forward variance, and he had a slide. I can't remember exactly what he had, a good wording of it, but it's basically like nobody cares about 30-day vol. It's like kind of like a who gives a shit,
which is counter to the other panel where they're saying no, both those 30-day out and 0DTE volume is separate and different.
Yeah. And then what Jem and I have actually been talking about for a while now, him and I have been talking about this privately too as well, and I think he's been talking about publicly. He's like, vol, like we were talking about earlier, it's moving to other asset classes and back, but like we were talking about the historical lessons, right? Like vol it gets compressed, and then vol explodes, and then everybody gets blown out, and then if they rush to buy those hedges, vol compresses again. And so we just keep going through these cycles over and over and over again, right? Like post 2008, everybody wanted insurance, but that was a good time to be selling insurance, and then until selling insurance does well, it compresses down. Then we have like pops like 2020, like it keeps expanding and contracting. And usually people are kind of on the wrong side, but it's just like that really historical references. Like you're saying, you have 2017, you had all sellers, and then February 2018, you had vol again, it pops. And then we reverse course again. Like it just keeps going back and forth.
The problem to me is the timing there, right? So like, cool, I know it's going to revert, but if it's post 2020 and that echo remained around for a long time, it's like, it took too long to revert and I got carried out on a body bag. Like, so you can know it's going to cycle, but if the one edge of the cycle takes too long.
Well, yeah, you can, you can predict things, but not the timing or whatever. Like you can say directional, but don't give a time frame. And so he's talking about like, 2020, everybody's saying, short vol sitting in equities, and then currently we're set up for a vol expansion. So once again, that's but once again, what is the timing? And Jem was just talking about with the debt ceiling and that anything under 2 years, the market is a voting machine. He feels that liquidity is slim in the tails, so maybe that's also why you could see that reversion of buying, and this is not investment advice, buying that skew, that deep out of the money skew, like if that liquidity is thin and people just keep rushing in there, on a potential, low liquidity environment, that you could see that deep out of the money tail like pop again.
Made me a little nervous overall that several people were like, oh, it's getting to be a better environment for that tail protection. Like if everyone's noticing it, is it really going to be there?
Well, as you and I both know, it's like, it might be a better environment, might be what we quote unquote cheaper, but it could be cheaper for years. Right. And get even cheaper than that. Right. So that's the problem. Right. But at least it's not, the asymmetry's back at least, but you might just still be bleeding out.
But better to bleed out 2% a year than 6% a year.
Yeah. Mike pointed out that everyone lacks conviction, so they're just buying calls for upside instead of delta one, which also might skew other people's metrics on like put call parity, et cetera, and whether the market is bullish or bearish.
Which also
Jem
comes
said
back to Jem's overall thesis that people are moving whole hog into options.
Yeah. And Jem said the recession isn't the biggest risk, stagflation is. So I thought that was interesting. Secular sticky inflation, and we'd have like a middling economy. I don't know how much I don't think he's been talking about that too much lately. So that was fairly new. Mike said though he pushed back, said he's not worried about stagflation, but he is worried that credit spreads could be explosive. And then you probably heard Jem say this before. He's talking about, once again, like quote unquote populism is local and capitalism is global, and he feels that we were shifting back to that local populism, where we've been in a global capital world for decades, or as he likes to call it, Planet Palo Alto. And then he referenced once again that the zero DTE becomes a problem if it gets unbalanced. But like everybody was talking about how balanced it's been. And then Mike asked that question again of like, if the OCC changes those intraday margin, is that a catalyst for that zero DTE to blow up? And they both kind of agreed that could be the potential catalyst. But that was it was a quick back and forth, and it ended rather quickly. And I'm not, they were trying to, I think, I didn't write the notes down. They were trying to basically go through a lot of history of options trading, back into like the 80s and 90s. So that's what I'm saying. I think it got too compressed and a little bit jumbled, and probably needed 2 hours for those two to have a good conversation.
They could have had their whole own day, right? Session panel 3 with Jem and Mike. Panel 6.
Yeah. And then after that one, I had to run to catch a flight. But then there was another, talking about QIS again. There's a fireside chat, about equity derivatives. And I really wish I could have saw the risk management portfolio diversification in 2023. But once again, had to catch a flight.
I hear you, and you got to go catch a flight now. So ish. Awesome. It's been fun. Thank you. We'll see you again next year.
This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of Mutiny Fund, their affiliates, or companies featured. Due to industry regulations, participants of this podcast are instructed to not make specific trade recommendations nor reference past or potential profits. Listeners are reminded that managed futures, commodity trading, forex trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they're not suitable for all investors, and you should not rely on any of the information as a substitute for the exercise of your own skill and judgment in making a decision on the appropriateness of such investments. Visit mutinyfund.com/disclaimer for more information.